China's economy grew at a sluggish 4.3% in the second quarter, a drop from 5% in the first quarter and a sharp decline from the more than 6% pace earlier in the year. This was reported by the National Bureau of Statistics on Wednesday. When you convert that quarter-to-quarter gain into an annual figure, it implies a 3.6% growth rate, which falls well below the government's target of between 4.5% and 5% and also misses the expectations that many economists had set. The Communist Party's decision to set that lower target discovered a sense of urgency about a broader economic slowdown, something that has been evident for several years now. While China's manufacturing factories are still running at high curve, pushing out microchips, electric car parts, batteries, and the like, the rest of the economy has not kept pace. A long-running property crisis, with construction volumes falling steeply, has a knock-on effect on growth. Many Chinese workers find that new jobs are scarce outside of factories, and wages are not increasing at a healthy rate. The retail side of the story is bitterly uneven. Consumer goods sales dipped in May for the first time since COVID-19 lockdowns ended. They only recovered slightly in June. That said, retail matters less when you consider the massive force of China's export engine. Export data for June was striking, with shipments rising 27% from a year ago. Chips, batteries and cars moved out of Chinese ports in unprecedented volumes, driving a trade surplus that topped $125 billion. That surplus is only China's second largest on record, a testament to the resilience of its production base and to global demand for high-tech goods. When you juxtapose the export boom with domestic challenges, the picture is that of an economy that is surfing a wave of foreign demand while its internal pillars are under strain. Experts say that China's success in the tech corridor is a significant buffer. The chief China economist at UBS Securities, Yu Song, remarked that the country's position in the worldwide artificial intelligence and energy savings sectors keeps it from a far sicker downturn. He added that, without that global boom, China's economy would be in a much worse state. That insight captures the tension. The export boom is a twin iron SP association. They keep growth figures in the black while domestic pockets feel squeezed. In the first half, industrial production climbed 5.4% over the year out, with high-tech manufacturing up more than 13%. Yet fixed asset investment, which bundles infrastructure, property construction and machinery, fell 5.7%. The oversight between a robust manufacturing engine and a weakening underpinning of investment and consumption is what sets China's economic trajectory apart and hints that the government's policy tools will be put to the test in the months. So what does this look like for the future? For now, the 4.3% Q2 growth rate suggests that China's markets hold a fragile optimism. The export surge offers a lifeline, but job creation, consumer confidence, and the housing market remain fragile. The gap between the export growth and domestic slowdown signals that China will need to shore up its internal economic engine. That could mean policy tweaks, incentives for domestic investment, or a focus on rural and suburban expansion. Whether those measures can close the gap between the government's target and the current reality remains the key question for analysts and policymakers. And that's the story, an economy that is making progress abroad while still fighting through domestic headwinds. The balance of growth will decide how China navigates the upcoming quarters. Thank you for listening. Until next time, stay informed, stay curious.